Helge, Tom just ably laid out this basic part that we're going to see this huge number, like 18, 19, 20%. But what should we really look at? Because we know it's a year-over-year comparison. What do you expect here, and what are you going to really focus on to get a sense of how strong this recovery is?
Yeah, so I think Tom put it exactly right. We are still a little bit concerned about the balance of growth below the headline. So the headline numbers will be large in terms of annual figures. It's often better than to look at quarter-on-quarter growth and and analyze this. And there we are thinking more about 4 to 5% of growth, which is a solid pace. But given the weak first quarter last year, this would translate in something like 18, 19%. Our concern is mostly on the consumption side. Investment has come back, the government is still helpful, but consumption has been weak all the way until the end of the last year. If you look at our pre-crisis forecast, consumption was about 4.5% lower than what we had at the end of the fourth quarter, while investment was more than 8% higher. So you can see the tension between these two very important components of Chinese GDP.
You know, China was the superhero of the economic world last year in 2020 when it contained the virus, first big economy to rebound, lead the way for the rest of the world. But now this year, there's growing concerns about China possibly falling behind in the vaccination process. And if it does, it kind of misses some of the reopening opportunities that are going to come from other countries in terms of demand, maybe even mess up the ability to do the Olympics. What would this mean for the economy, and what do you see now?
We see vaccination as an important part of China's return to full normal capacity, just like we see it important for other countries. The authorities have an ambitious goal. They think they can vaccinate 40% of the population in July. I hope this works. It will be important to get this additional final distance to full capacity use that we're still seeing and as outstanding. And it will help stabilize consumption. And with the consumption accelerating, we should have a balanced recovery by the end of the year.
Okay, so with a balanced recovery by the end of the year, with these very solid numbers, why does the IMF say, including you, that China still needs to maintain very accommodative monetary and fiscal policy?
Yeah, we are, hoping for rebalancing in the course of the year, but that comes with certain assumptions. It comes with the assumption that macroeconomic policies will remain supportive, that they don't prematurely withdraw the support, both on the fiscal and the monetary side. And fiscal policy can help by more than just getting the fiscal deficit right. It can also help by changing the composition of fiscal support a little bit away from investment, which is the current main focus of fiscal spending, towards household support. If you support the social safety net in China, which requires some support, which is not as strong as it should be, you will get a two-bang result. One is you can support the rebalancing this year, but you can also start that transition to high quality growth that I know policymakers are looking forward to. So, for us, this is both a necessary condition for the recovery unfolding as we hope for, and a bit of an insurance in case things are going wrong.
How about massive U.S. fiscal stimulus? This is something that is already showing up in what's starting to look like the kind of economic boom, not just a rebound, not just a recovery for the U.S., but a boom. I know that was a big reason for why you upgraded your forecast to 8.4 from 8.1. Is it possible that it will make China's growth even better? And or if the U.S. stumbles, what does that mean for China?
Well, it's an important part of our upgrade, but it's not the only thing that's going on. We also have seen that the kind of pandemic-focused exports that have been surging in the course of last year, as China was producing and was able to produce the goods that the world needed, that they seem to have peaked. It's a bit early to tell finally, but there are signs that they may have reached their maximum. Fiscal policy is retreating a little bit faster than we would want it to retreat, which also sort of creates some headwinds to growth. So in the end, our upgrade to 8.4% for the year is a balancing act between these different forces, and the U.S. stimulus or the recovery in other advanced economies only one part of the equation.
You know, when we're looking at Huarong, which again, Tom just set us up so ably for, It's ironic that this is a state-owned enterprise that was set up in, the 90s after the Asian financial crisis to deal with bad debt. And now it's become a very bad bank, right? So all this fallout now, all these concerns, will the government bail them out or not? Step back. Is this a financial stability issue potentially? Does it tell us there's maybe deeper currents that could emerge?
Yeah, I think as you allude to, there's some special circumstances around this particular company, but I think the whole episode, the last few months where we have seen SOE bonds showing signs of pressure on the financial market has some messages for us. I see mainly two. The first one is that the pandemic has put enormous stress on the Chinese corporate sector. And it doesn't really matter whether this is the SOE or a privately owned firm, but altogether the corporates, like in many other countries, faced hard headwinds. And there it was enormously beneficial for these companies to have access to generous credit facilities in China. But as a consequence, debt went up. It was already a high in the corporate sector before the pandemic. It's now about 10 percentage points higher because of the pandemic at around 127% end of last year of GDP. That is a high number, by any standard. So we need to think about, for any one company, what is next. And as the recovery comes online, but we still see some firms struggling, it's time to look at bankruptcy frameworks, make sure that we are, in a position to deal with non-viable firms and help them restructure or, ultimately go bankrupt. But there's a second message, and I think that is just as interesting, which is that here we have a sign that a non-viable state-owned enterprise, just like any non-viable private-owned enterprise, can indeed might fail. We don't know. So I'm not talking about the specific SOE, but about SOEs in general. That SOEs can face this kind of market pressure is, in principle, a good thing. It is a good thing because we know that the SOE sector needs reforms, that we need restructuring going forward, and that so here this is a good sign. Of course, we want any such process to be gradual, well structured, and there's no reason for this at all to lead to any tightening in financial conditions.
Well, how concerned are you about the growing U.S.-China tech war? Last week, President Biden added 7 supercomputing, Chinese firms to a list of entities that U.S. businesses can't sell to without special permission. That's just a very specific step in something that started with Donald Trump. Joe Biden seems to be carrying the mantle. Europe is looking at this as well.
Well, the tensions around the U.S.-China relationship are one of the risk factors that we look at, and if you have seen our work in the course of the last 2 years, this is a constant concern. There are 2 aspects to it. One is that the trade tensions haven't gone away. Just because we have stopped talking about the tariffs that are in place between the 2 countries doesn't mean they're not there. And they have subtracted from growth last year, and they will subtract from GDP this year. We think globally this is to the tune of 0.4% of GDP. That's a large number. But things could become more difficult if we allow technological decoupling to take place between the US and China, between other countries like Europe. Because the world is such an integrated place, if you stop trading in technology, including goods, if you stop working with the global supply chains as they are in place, if you stop exchanging knowledge across country borders, you will ultimately pay a price. And this could be fairly high. Our research that we recently published shows that it could be about 10 times higher than the losses that we forecast the trade tensions have. So we're talking about numbers up to 5% of GDP. So it is important that these 2 large, very important economies that are such a large part of where the global economy goes, find a way to work together and work to improve the global trade system, to adjust to these new challenges and help us all and help the global economy moving forward.
A warning from the IMF last week that There's a threat to emerging markets if the Federal Reserve starts raising rates abruptly, or even just signals all of a sudden that they're going to do that it could hurt emerging markets in developing nations. China's the second biggest economy in the world. In many ways, it's a very rich country. They don't look like an emerging market at all. But I just have to ask you, is that a risk to China, or are they immune?
They're not immune. Nobody's immune in a globally integrated economy. But let's note the fact that China, in terms of financial markets, tie into the system that evolves around the Federal Reserve, is not as exposed as many of the small economies in Asia. For them, for these small economies, it's very important that we have monetary policy in the United States that is gradual, that is well communicated, and avoids sudden turns that could lead to sudden changes in financial conditions.